Well, hi everyone, and welcome to the Buffett and Beyond Research Weekly ETF video letter. And today it's all about hedging your ETFs. And folks, we've got some pretty good numbers in here, and you're going to see where we're going with this research, which might be done in another 2 weeks or so. But we've started, and we're going to show you the results that we have right now. And remember, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And okay, here's what we got. We're just looking at the year 2020. So this is from 12/31 of 19 to 12/31 of 2020. So this is the year 2020. And we're looking at the IYT, which is one of the transport ETFs, and these are the stocks that we had back in 2020. And so we're looking at the returns of the ETF itself, which was 12.8%. But the top stocks, and remember we're using the clean surplus methodology, the clean surplus return on equity methodology, to pick out the top 5, 6, or 7, or 8 stocks in an ETF or any ETF. And we use the clean surplus return on equity to do that, which is not shown here. So we're looking at the stocks. How did they do? Well, they average 48%. So with the index up, or the ETF up 12.8%, the top 5 stocks of this ETF returned 48%. And folks, this is research that we've been doing over the years, and every time we pick the top stocks, whether it's the top 5, whether it's the top stocks with an ROE over a certain percentage, which we use as 20%, if you pick the top 1/3 of the stocks, it all comes out the same. We keep outperforming the ETF. So we're looking at a very good strategy here. But the thing is, what happens if the market goes down and we're in stocks that are returning this much? How far are they going to go down? So one of the things we want to do is, what if we bought the top stocks, and it could be 5, it could be 7, it could be 8 or 9, and when I say top stocks, it's the ones with the highest return on equity in a clean surplus condition. So not the biggest stocks in that ETF, it's the most efficient, the ones that are making the most money. Let's say it very nice and easy here. So with the stocks making 48% and the IYT making just 12.8%, what our strategy is to buy the top stocks and short the IYT, or buy an inverse of the IYT. So in an IRA, you can't short a stock. In a regular account, you certainly can, but in an IRA, you can't. So we can buy the inverse of this IYT. So it's either one or the other. You're going to be hedged the portfolio. So you buy, in this case, the top 5 stocks, and we returned 48%, but we shorted the IYT, which means we lost 12.8%, because shorting means you make money when a stock or an ETF goes down. So you lost this, but you made this. So the overall profit in a long short ETF, using our strategy, you made 35%. Okay, what does that do? Because a lot of you who want to hedge usually are older folks, or you just started retiring. Let's say you're 65 years old and you have a $3,000 portfolio. And I see that quite common out there. Even though we see a lot of people who don't have $3 billion, but we see a lot of people that do. So we took these 5 years, including up to September of 2023. So we started 2019, 2020, 21, 22, and 3/4 of 23. So what did the S&P 500 make? And the SPX is the symbol for the S&P 500. What did it make on average? Well, it averaged 13.7%. How about the top stocks? What did they average? Well, they averaged a return of 34%. And we're looking at the transport ETF. What if you went long and short? What did you average? A return of 24%. So you're almost doubling the S&P 500. Now, standard deviation, I won't go into that much here, but it's a measure of how much you deviate from the average return, or the mean return, actually. So we won't use that right now, but we want to look at, okay, you come in here, you have $3 million, or you have $3,000. You could do it with $300,000. You could do it with smaller accounts. So that's the beauty of this. So what is the biggest drawdown? Well, with the S&P 500 and these particular years, it was 2022. The S&P was down 19.5%. The QQQs and the NASDAQ were down 34%. So what did the top stocks go down? Well, they went down 26%, actually down more than the market. But what if you hedged? What if you were long those top stocks and short the ETF? You only lost 3.2%. So, of course, if you're going to hedge, you're going to have less of a downside problem, but you're going to be capping, or not capping, but you're going to get less of the upside. So when we look at the average, we're going to see that the S&P 500 returned 13.7%, the long short 24%, and this is per year, by the way. This is the average per year. And the top stocks returned 34%. So you're saying, well, gee, I'd rather be in the top stocks and make more than less. But don't forget you had this drawdown here. And let's look at it in dollars. So if you had a $3 million portfolio or a $3,000 portfolio, you just take some zeros off here. Well, if you had the $3 million portfolio, let's put it in dollar terms, you would have lost the biggest drawdown in 2022. You would have lost $585,000. With the long short, you would have lost just $96,000. If you didn't have any shorts or any protection with the top stocks, you would have lost $780,000. So when you're looking at your $3 million and you're retired and you're saying, hey, I don't want to see a drawdown of $780,000. Now, don't forget, in 2008, the S&P was down 40%, or actually, I believe it was down 38%. It had been down more than 50%, but it ended the year down 38%. So wouldn't you rather be down maybe 5 or 6%? And here you would have been down 60, maybe 70%. So that's a big loss to make up. So when we look at these numbers here, we say maybe I would rather lose less than more. Or if I invested in the S&P, I would still lose a lot less than the S&P 500, about 1/6 as much exactly. Now, what about the biggest gain? Well, the biggest gain came in various years. For the S&P 500, the biggest gain would have been $867,000. With the long short, it would have been $1,731,000. And if you didn't hedge at all, you would have had $2.25 or almost $2.5 million. So your question is really right in here. What do I want to protect, and how much am I willing to give up on the upside? So when we look at what's your other alternative, investing in the market or the S&P 500 itself, I would rather have lost just 3.2% rather than 19.5%. And look at the gain, though. The gain is twice as much as the S&P 500. So in this case, you're gaining more by hedging than the S&P 500. You're gaining twice as much, and you're losing like just 3% here. So we have to take a look at that, folks. Now, let's go to home construction. Same setup here, so I won't go over all the numbers in detail. But the home construction made 47%, and this is in 2019 again, made 47%, almost twice as much as the S&P 500. So we're looking at the home construction, and we're looking at 7 stocks here. We would have made 47.9% had we just invested in the ETF. But what about the top 7 stocks? Wow, almost double that, 82%. But if you were long and short, so you were short the 47% and long the 82%, you would have come out ahead 34.5%. Let's look at the next one. So we're looking at the home construction here, and let's come down bottom line. Again, the S&P lost 19.5%. Your biggest loss here was 4.8, and your biggest loss here was 31.7. So as you look at these numbers, and then we transpose them into numbers, if you invested in the S&P 500, you would have made 867, but you would have had to witness that drawdown of almost 20%. Here, with the long and short portfolio, you would have gained 34.5% or $1,035,000, and if you didn't hedge, you would have made almost $1.5 million. So what you're looking at is the drawdown. Well, the drawdown here, if you invested either in the S&P 500, you're drawing down almost $600,000. You're drawing down in the home construction, just the long stocks, almost $1 million. That's a third of your $3 million here. Or if it's $3,000, you're losing $1,000 out of that $3,000. But here, if you had gone long the stocks and short the ETF, you would have lost $144,000 out of $3 million. So this is the decision you have to make. On the upside, you would have beat the S&P 500, but you wouldn't have beaten the long stocks only. But look at the drawdown. The drawdown's only 4.8%. So let's put these two ETFs together, because when we do this, we want to put 3 or 4 or 5 or even 6 ETFs together so that you have a portfolio. So when we average the two ETFs that we just went over, the biggest drawdown if you're hedged was 4%. Biggest drawdown if you were long the stocks only, 28.8%, and the S&P, we already know the biggest drawdown was 19.5%. So when we look at the biggest gain, then we're looking at $867,000 for the S&P, almost $1.4 million for our long short, and up $1.9 million for the top stocks. But look at the drawdowns here, negative 4% in the worst year, which was 2022 over the past 5 years. So we're going to show you all years such as 2008 when the market was down 38% for the year. Even last year, the NASDAQ was down 34%. So if you were in the NASDAQ stocks or just bought the NASDAQ or the QQQs, you had a tough year last year. So this is what we're looking at. How do you hedge your portfolio but still make a lot of money? So in other words, you lose less than the market itself, but you make more than the market on the upside. So you make more and lose less if you use the long short position. So folks, we had quite a lesson right here. And yes, there are ways to hedge. And the greatest thing about this hedging is you do it once at the beginning of the year and you walk away, because we pick the stocks for you. We'll tell you what to get into. We can even form or have money managers construct the portfolios for you, and you go to the beach without even thinking about it. If you want to do it yourself, you follow a money manager that we might be affiliated with, and you or that uses our strategies, I should say, not affiliated with, but subscribes to our letters, then they'll show you how to do it. So you lose less and you make more. That's a pretty good strategy, folks. All right, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. All right, folks, go out, have a good weekend. We'll see you back here next time.